Good afternoon, everyone. This is Tom Hulick, the CEO of Strategy Asset Managers. We'll start probably in 1 minute. We're allowing people from the waiting room to join us. So please stand by. Okay, let's get started. Joe Traube, Alex Hagstrom, and I will cover the 2022 recap of what took place. We'll talk about key points for 2023. Joe and Alex will cover a majority of the outlook as they always do. But in 2022 was obviously a tough year for stocks, international stocks, bonds, and the momentum in the markets was very low. However, Strategy Asset Managers model portfolios did very well, outperforming our indices, and we maintained a 4-star Morningstar rating, which is quite an accomplishment for the group. We're excited to share that with you. Joe Traube will talk about the 2023 points that we have, but our theme will come back to, excuse me for my phone going off. It'll come back to being made in America, and Joe will comment on that and how important that is to see a lot of the manufacturing that's starting to increase in the United States, technology improving. And Joe, why don't you kick it off with that intro?
Yeah, thank you, Tom. And again, as we do every year, we kind of reflect back at the previous year and look at the opportunities ahead. As Tom mentioned, last year was a difficult environment. You don't have many years where this many asset classes were lower. And as we prepare for 2023, I just want everyone to know, just because the calendar flips doesn't mean our strategies do. Now, when we look back at 2022, one of the big reasons why our strategies did do well, it was the sector rotation. As we know, technology has been a leading theme, not just for the US, but globally. And technology really took it in the shorts last year. And some of the areas that did well, obviously energy, but also when you think about defense companies, and those two areas were bright spots and actually were positive last year. You also look at more of the defensive sectors like utilities and staples. And as we've seen, as technology's gone lower, the overall market cap for the S&P 500, you're going to see some more shifting as this year progresses, just as the S&P rebalances. So again, for us, it was the sector rotation and being on the good end of the sectors that did well, and obviously being underweight things that did not do so well. One of the big themes that we talk about going forward is that why do we see opportunity? And again, we focus in on 3 principles right now. It's employment, credit, and spending. And those 3 are pillars of strength, and that remains healthy and in good shape in the United States. Now, we know a lot of people are talking about an imminent recession that everyone is thinking is going to happen this year. We do know the global economy is slowing. We also know that big technology and media are cutting jobs. Just yesterday, Facebook announced 11,000 job cuts. But we also know when we look at employment, it's historically low. Credit is still available. That's by Visa, MasterCard, even American Express. And we also know inflation is cooling. Recently, we saw the inflation numbers come out and actually we're down 3% from the peak. So again, we know people want to get out and travel. Anyone that's been on a plane or tried to go to a hotel, they're short-staffed. And again, that is going to continue, especially as China reopens. Now, I want to just briefly touch on, as Tom mentioned, one of the big themes that we see is made in the USA. Now, why do we say that? Well, just kind of, again, look back what happened during the pandemic. We had a complete mess in global supply disruptions. And what we started to see when we listen to earnings calls, it's CapEx, which is capital expenditures. And this means where companies are investing. And we saw a huge, going forward, companies starting to invest back manufacturing in the US. And when you kind of think about this, it makes sense. You saw tremendous advancements in technology. Think of automation and robotics. As labor costs have risen, it makes more sense for companies to continue with manufacturing and getting AI involved. So we do think not just machinery, but when you think of plants, capital projects, this is great for our economy because these are good paying jobs. So we also could see a boost with energy prices. So as energy costs in the US, we saw from a year ago, actually skyrocketed. We do think at this area that benefits America. The last point I want to make out is what areas does this benefit? And we can kind of think anecdotally, it helps supply. We've already seen with technology and the Zoom call that we're doing now, we talk about healthcare. I have a couple calls next week with my doctors. So again, these are just innovations that have happened. And then you also look at going forward, what can happen? And you can continue to see not just spending in the public sector, but also the private. One of the big things that we're looking at is our grid, the electric grid modernization. We know that we've had huge power outages in Dallas as well. So you could see infrastructure spending on these areas that need improvement, and also just on reshoring supply chain disruptions. A benefit is if we start seeing the US dollar not go as much as it did last year, go up as much, that's going to help companies that manufacture in the US and export overseas. So we could see a boom again in manufacturing as input costs, think commodities and labor, transportation, all head lower. These companies aren't going to lower prices. They're going to maintain their prices and get their margins back up. Just a few things I want to talk about. Alex is going to talk about the economy and certain risks we're looking at. Alex, you want to?
Yeah, so one of the big economic stories over the last half year has been the fall in inflation, and year over year inflation has declined for 6 consecutive months. It peaked in June of last year at around 9.1, and it's now down to 6.5. And if gas prices and housing prices can remain near where they are today, we will continue to see that year over year rate decline in 2023. Used car prices, which were a huge factor in the inflation spike, have been normalizing real rapidly. They're now down 14% on a year over year basis. That's the biggest decline in history. Retail inventories are at the highest levels we've ever seen. So you can expect the prices of goods to decline this year. You know, the fall in inflation has been positive in many ways, not just for consumers, but because it's allowed long-term interest rates, including mortgage rates, to start falling. Now, keep in mind that long-term rates are not directly controlled by the Federal Reserve. That's why they've been able to fall despite the Fed continuing to hike. And those falling long-term rates have been a huge factor in this recent rally. Now, with inflation and long-term rates starting to fall, one of the biggest worries right now is the debt ceiling, especially because there's been a lot of misinformation put forth by the media regarding it. It's been framed by some as a situation where the US is at risk of defaulting on its debts. That is 100% false. There is no risk of the US defaulting on its debt. The debt ceiling debate is actually a debate over whether the budget should be balanced going forward. And if by some chance there was no increase in the debt ceiling, the government would just be forced to cut its future spending. It would not mean defaulting on the debt that's already out there. But of course, with all that being said, the debt ceiling's been raised 78 times since 1960. We've seen this exact same scenario play out time and time again, and it is overwhelmingly likely that a deal will eventually be reached sometime this year to raise the debt ceiling for a 79th time. I know that doesn't make for an exciting news headline, but that's definitely what you can expect to happen sometime later this year.
Yeah, and that's a good point. I mean, some of the risks that we see for the markets, it's interest rates if they stay higher for longer. And we look back at last year, we had talked about one of the things we were looking at is the potential resetting of expectations. And that's what happened as the market had to reset higher interest rates. Now that we've seen that, it's good for people that are savers, not so good for people that are lenders or people that are on the opposite end. What we can see is this is just, again, a risk if credit continues to tighten. And we would then see unemployment potentially rise. And then this would be spending declining, which then lowers corporate earnings. Now, one thing that we just looked at, anyone looking for a new car, this is the highest amount on record for people paying over $1,000 a month for their vehicle. This is not a house payment, this is their car payment. And again, for us, as we see prices starting to cool, and we've seen the used car market really come down, and again, you're starting to see a little bit with new car prices coming lower, and we'll talk about that a little bit later. But those are some things that have us concerned and are tracking. Because if you start seeing credit tighten, then the lending that also spreads over, and you could see not just companies, but also households not being able to service their debt. We're not in that case right now, and this is just from the calls that we've listened to. Credit is still available, and more importantly, people are servicing, they're paying down their debt. So that's where we see it right now. But again, that's a risk that we can see going forward.
Joe, and Alex, let's talk about the dislocation with the government data that we see, and that's a key point that we bring up in our meetings that should be shared with the group.
Yeah,
Alex?
I mean, yeah. So, excuse me. Yeah, so the government data, specifically the jobs data, it is extremely strong right now, and it's not data that has ever been, consistent with a recession. That being said, these data series, they are heavily revised, and often they lag. And one great example is housing inflation, right? We all know that housing prices are going down, but according to the government, they're making new highs every month. So that's that lag which you see. The good thing about that is it's going to push inflation down in the back half of the year because the house price declines that just happened are finally going to be registered.
And it's important when you look at shelter index, that's housing. It's also two components. One is people that are on mortgages. And again, most people are on fixed mortgages, not variable. So even though we've seen this huge increase in rates, it's not affecting them. They're fixed. The other part is we actually saw on the short end, the 30-year probably touched around 7% for a 30-year mortgage, and it's down close to around 5.5%. So with that, again, these are just dislocations that you see with the market, and it's a lagging effect that as this year progresses, you'll start seeing rent prices, as they normally do, lag anywhere between 6 to 9 months.
Joe, let's talk more about some of the positive catalysts that we see for 2023. And I know that we've been talking about the Made in America, that some of the trade agreements that are going back and forth between Mexico and the United States, and how that's going to impact U.S. manufacturing and also U.S. equities. But let's go back and talk about the positive catalysts.
Yeah, so some of the things that we're watching for in 2023, it's really our theme is to keep it simple. So we do think this is going to be a much easier year to navigate because we're going to be on the back end of inflation. Last year, inflation continued to go higher. This year, we're seeing inflation go the other direction. We also look at the effect on interest rates as we were dealing with higher rates. This year, the market's actually expecting maybe a couple more rate hikes. And then as you look at the latter half of the year, rate cuts. So it's a very different dynamic that we're seeing for this year versus last year. Now, one of the things that we're constantly asked is, well, where do you see opportunity? And last year, we went into energy and more of the materials, and again, some of the defense. This year, we're looking a little bit more with the manufacturing. And again, it's the consumer coming back. So those are good things that will, when you talk about just consumers traveling, you also think about energy and manufacturing. This helps middle America. You start seeing small caps do a little bit better. And anecdotally, think about a restaurant that didn't have any manufacturing near it. All of a sudden, you have a plant now that's being built, and you have people that need food. So it's those types of opportunities that we could continue to see happen in 2023, both domestically and also internationally. So a lot of talk, and January has been a very strong month for the markets. We've had a very good rally, and it's also with today as well. And a part of that is, again, it's resetting of expectations. As we said, the beginning of this year, expectations were low, just like they were in June when the markets were down close to 30%. We didn't panic, and we gave people reasons why to be optimistic. And we've seen a big, rally that's, again, been up and down, but definitely recouped some of that losses.
Let's talk a little bit about active management and why it's so important now. For the last decade and beyond, passive index funds significantly outperformed active management, but there is a kind of a pendulum shift back to the active management. Advisors are very relevant at this stage with the allocation in their clients' portfolios. That includes strategy asset managers and what we selected for our specific portfolios. So let's talk a little bit about active management and why that's going to be very important going forward.
Yeah, and like we kind of touched on the sector rotation, and it was really technology that had been driving not just the US markets, but the global markets. And what we've seen is a reshift into other areas. These are other sectors and other companies. And if you're just sticking with the index, you're going to continue to be overweight these companies that aren't doing so well. And that's where active management can add companies that are, again, maybe not be as large market cap as the index and can go international as well. So different areas to shift out of the benchmark, that gives much more opportunity for active managers to, again, go out of just the normal benchmark. And one other point to be made, when we say keep it simple, for those of you that have been following a company like Bed Bath & Beyond, you've had a tremendous increase in what we call the junk names, or dash for trash, in the last month and a half, month and change. And what typically, this is good for the overall breadth of the markets, but for us, it doesn't have sustaining power because these companies are still ultra leveraged. And again, just because rates aren't going up as much, they still have debt to be paid. So again, return to high quality, which did well last year. And we, again, expect it to do well this year. Again, with ups and downs of a normal market cycle, that should, again, help. And if people are, again, another opportunity that we did not have a year ago was fixed income.
Correct.
And that's a big point. And we'll talk about this just briefly. If you look back a year ago, anyone that had a bond or a money market rate, you were earning close to nothing. Now the Fed has raised rates considerably, and we can get 4.5% yields. And that's US Treasury. And again, so that's very safe. And it's on the short end, meaning less than a year that you can be getting that. So when we look at longer duration, it's 3.5. But again, now you have an alternative that's risk-free, and you've seen money market rates, move up as well. So that gives you just a little bit more of a balanced approach, which you may not have had last year.
Alex, why don't you touch a little bit on that as well?
Yeah, and also I think with rates so high, it's essential to have someone who is selecting companies that won't go bankrupt, right? With rates at zero, no one's going bankrupt. So who cares, right? Now you need someone who's going to, analyze the balance sheet. What is their debt? When is it coming due? Do they have to refinance? That kind of analysis is critical now.
Very good. Sector rotation was important at last year. It's also even more important this year. Let's talk a little bit about the sector rotation.
Yeah, so one of the things that we saw again last year was technology, which was the largest sector, and that really underperformed. And the sectors that were smaller weights, I mean, energy's more than doubled in the S&P just because of the price appreciation. And another one that you kind of think of, they call it the consumer services or communication services. That is another area that shrunk. And with the rebalancing, and this is going to happen with the S&P this year, it's going to get a little bit smaller as well. So what does that mean for active management? What sectors look well? Again, we continue to see a shift toward some international that looks attractive. And again, if you have manufacturing.
Why is that, Joe? And let's talk a little bit about specifically why we see some opportunity international.
Yeah, it's the expectations. The worst case scenario, I think, was priced in, and you're starting to see the worst case scenario not happening. So you're getting some, I'm not saying certainty, but you're getting, people are getting out again and working, and this is helping both corporate America and also overseas. And a big part of that component is financials. So when we look at the financial shape of not just our clients, but the companies, it's the same thing. Countries that have their finances in order have a tendency to do better. And when we look overseas, we're starting to see just today, the ECB, that's Europe, and also the Bank of England, they both raised interest rates 50 basis points. So typically, we see this happen, and then in the US, and then you see it overseas. So that's going to be kind of a shift where we're starting to see what's happening here, happening overseas. And again, I think that's a positive catalyst as this unknown is no longer an unknown. These certainties are getting priced in as we do know how they're going to do. And then that's how companies can prepare. So I think that's going to be a big part of 2023.
Alex, do you have any comment before I ask?
And I think foreign stocks, that's another area where it's essential to have someone picking stocks for you, right? Because these are, sort of socialist type economies in many sense. So over very long time horizons, they don't do as well as the United States. So you really need to pick the right companies that can thrive in that sort of economic environment.
Good. We talked a little bit about real estate as a sector, and let's just review what our position is on industrial, commercial, residential, just review. And then as a sector in general, most people have real estate in their portfolio, whether it's their home or they're in a passive investment through a fund or a limited partnership and or beyond. So let's talk a little bit about that, Joe.
Yeah, and that's a really good question. You look at the private sector versus the public sector and think of public REITs, they were down 30% last year, yet the private was not. And a part of that is having mark to market. And what we could start seeing this year as we just get a cooling off in interest rates, home prices stabilizing. And again, that could be something down the road that is in a much better situation. So right now, when we look at prices of homes, we know they're going lower, but it's been very stable when you look at the industrial side, and those are the big warehouses.
Well, let's talk about the point of going lower, because that depending upon the market that you're in on residential, housing prices in Florida are up 20%. California is still maintaining, values. So it really is geography specific. I guess where I was trying to get at was when we talk about real estate as an asset class, we have reduced our exposure in commercial, industrial, real estate, passive investments, or some of the limited partnership allocations that we have there. And that is an active management decision that Joe, Alex, and I and the team have made for our market outlook. Correct, Joe?
Yeah, it's really the cost of capital. I mean, as rates have gone up, it's and when we're saying prices declining, we're not looking at a 2008 crisis. I want to reiterate that.
Thank you.
It's just again, things just don't keep going up inevitably. Anyone that's been in a home, to have 40% appreciation in a couple of years, that's not the norm. So again, we think it's just a settling down, and that's where again we think prices aren't going to be going up like that, just because everything went up skyrocketing during the pandemic, and again, so it's a reshuffling and getting into the new cycle.
Yeah,
And
shortage
again,
of inventory also in the housing market, will keep prices, relatively stable. I don't see a precipitous decline in home values in any of the geographical areas that we have a majority of our clients.
yeah, I mean, it's always geography's region, right? It's location. But we're seeing when you look at just the U.S. in general, prices have slipped. And again, with mortgage rates going lower, you've actually seen a little rebound in that as well. And this is just really preliminary data. But again, those two go hand in hand, but it's not showing any alarms that are going off right now. And that's when we look at the strength of the consumer, not just with shelter, which is the largest percentage people spend their income on, but also when you look at just spending habits in general. And the best place to look at that right now is the banks with credit cards. That's where their big revenue generators are. And they're not seeing any big meaningful delinquency rates. Some of the more aggressive cards did, but all in general, people are servicing their debt. But this is something we're paying attention to.
Joe, Alex, I'm going to throw this at you. The Federal Reserve could raise rates another time, another 2 times. They could stop. What's your outlook?
Yeah, I mean, I think it's pretty clear that, barring some sort of really secondary spike in inflation, that the hiking cycle is effectively done, whether it's another 25 or another 50. Regardless, they've almost reached their terminal rate. And what's going to happen is they're going to hold rates at that level until they see inflation data normalize. And so they have a 2% inflation target, right? Inflation was 9, it's dropped to 6. So we have another, let's say, 3% to go to get in range. And once they see those sorts of inflation data, then they'll be able to cut rates again.
Joe?
Yeah, I mean, I'm just going to talk about one other thing. I like to talk about things that we know and we have experience with. And one of the things when we were talking about prices getting lower, and because of where interest rates are at, the home price or also car prices of being $1,000 a month, you've seen exotic car prices decline about 3 to 8% a month for the last 5 months. So just as assets have come down, these are assets that we have to remember went skyrocketing up the last couple of years. And you should expect that in a normal market cycle for it to cool off. Tom has experience with trying to sell a car as well, but these are things that are real, and you are starting to see prices come in, which I think as inflation cools off, rates should cool off, and that'll give some stability to prices.
Yeah, timing is everything. Joe made the comment when my father passed away, he had a luxury car and held on to it for 8 months. If you sold the same car that he bought 12 months ago, the price was 50% lower. And that's obviously a shock or a dislocation in the market. So if you're being forced to sell, you have to pay the price of the discount that somebody will pay you today. If you can wait it out, then you could see a reversion back to a mean or some normalization of prices, which we're seeing, and that takes time. Timing is important, though, and timing is where I want to ask the next question to Alex and Joe. The markets are forward-looking. We're in January, and by the time that we see the indices start to track, gain more confidence, the horse has left the barn, type of thing. So let's talk about timing and being invested in the right sectors, and even talk about fixed income in that opportunity, as well as we reposition clients as bonds come due. and buy higher yielding fixed income instruments.
Yeah, and that's an important point to make. The stock market is not the economy. The stock market historically turns up before the economy does. And when you look at just performance on the S&P, we started to see stabilization, and then in October, some price moving up. That continued in January. And it's usually a lag of about 6 months. So we can expect to hear more negative economic data, and again, have some reasons that we could start seeing a stabilization in beginning of the third quarter. And that would bode well for not just the economy, but obviously the stock market as you get some stabilization there. But that is a good point to remind everyone. The stock market leads the economy historically around 6 months.
Alex, you have a comment on that?
Yeah, and it's critical to stay invested, and it's critical to own companies that make it through recessions, right? You don't want, a company, again, Bed Bath & Beyond, that's just going to go to zero if there's any kind of economic decline. You want quality companies that have made it through recessions in the past. And so if and when the economy does turn up, their stocks are going to, rally very strongly.
So should I use all my Bed Bath & Beyond coupons right now?
Should sell the stock. They're probably going to go bankrupt this week, but the stock's up 100%, going into bankruptcy. Just instead.
Yes, Tom, use your coupons, but you might not have any inventory if anyone's been in a Bed Bath & Beyond.
I experienced that. There is a shortage of inventory out there, but it is catching up. All right. So in summary, we talked about we gave the recap. 2022 was a rough year. 2023 key points. Strategy asset managers, active management portfolios did quite well against their peers. And the message to those on the call, as well as to those who will listen or read the market outlook, is that you should stay invested, but you must be in the right sectors for 2023. And we talked about those sectors. It's also important to have a good perspective with inflation and interest rates. And we think that inflation is tapering. We know that interest rates are probably peaking. Is that correct, Joe?
Yeah. And again, when you look at, these are just historical data that's put out there, but the expectation is another 25 raise in March. So next month, another 25 interest rate increase. And then it gets kind of maybe a couple more hikes, maybe, or maybe one. And then they start cutting rates by the end of 2023. And then you look at 2024, again, rates are heading lower. And that's just how the yield curve works. The longer duration are lower than the shorter duration. And that's where we see rates, settling.
So we're planning now for what lies ahead in the second half of 2023, and we're seeing some positive signs. As you've seen, January kicked off well. You want to talk a little bit about that historically?
Yeah, just looking at some of our technicals, and the S&P just hit its first upside target. So what this means is you're seeing more, again, the breadth is improving, more stocks are participating. That's a healthy sign. Good. And as you take out, these lows and the market price goes above it, you just get people more confident. And like Tom said, if you don't have to sell and the assets keep coming up, you're not a forced seller, you can withstand the price fluctuations and look for a better day. The last thing is, we always are optimistic. We know conditions right now are mixed, but we do know conditions will improve as we get more certainty regarding earnings, inflation, interest rates, and obviously the geopoliticals. It's always up and down. But know that the market climbs a wall of worry, and we know a lot of the unknowns right now. And again, I just think as we get more certainty, people are going to feel better, and that's going to help the markets.
Good. Earnings season, how is it shaping up?
The best word so far, and we have a couple of big bellwethers right now, Apple just reported, and it's better than feared. So what I mean by that, the expectations were for a complete collapse. We're not getting that. We can see backwards companies did better than expected, which they typically do. They lower future guidance so that they can beat those numbers. So the preliminary data has been better than feared. We are seeing a slowdown in earnings, and that's the forecast for next year. But again, that's just the next quarter. So not to be too short-term dated, you do have to look a little bit longer term. So earnings to stabilize, and the pictures, again, for tech, after 3 years of just huge growth, there's just, again, some excess that needed to be trimmed, and that's what we're definitely seeing. So I don't want people to get concerned when they just see the tech earnings. You know, there's many other sectors to look at.
Talk a little bit about dividends and the health of dividends for U.S. corporations in our specific portfolios.
The two things that I love hearing, pricing power and cash flow. And, you know, anecdotally, when I go to the pump to fill up gas in my car, I like to own those companies as their prices keep going higher. And that's the same thing when you look, when you go shopping, which companies can raise prices. That's very key because as we've seen input costs head lower, they're not going to lower costs or lower prices for us. So those companies have good margins, and those are the companies you want to own. And it's also, like Alex mentioned, cash flow is king, especially when you have this type of environment. These companies do not need to borrow money, but if it's low enough, they did. And I remember last year and the year before, a lot of these companies didn't need money, but with rates, you know, at the time they were borrowing less than 2%. You know, they're very well capitalized. So those are the companies you need to own. Again, as we get through this short-term cycle where you're seeing a lot of the things that did really badly last year pop up, remember, if a company goes bankrupt, you're a shareholder, you do not get anything. So that's just something to keep in mind.
We're not in any of none of the companies that we own are in danger.
But we do look at dividend safety, and that's why I like the cash flow. And we have seen a number of companies that we own also raise their dividends. That's a healthy sign.
Good. Alex, do you have any comment?
Yeah, just, stick to high quality, low leverage, good business models, good management. Just stick to those fundamentals. And regardless of how the economic environment evolves, you're going to be okay over the long term.
Good. Okay. We've been speaking for nearly 40 minutes. Today is Groundhog's Day. Punxsutawney Phil saw his shadow. Is that right? So there's 6 more weeks of winter. Is that correct, Joe? Is that what we heard today?
There's 6 more weeks of winter, yes.
Yeah, I can't remember that. Not here, I'll tell you that. Let's hope. We've got a lot of rain out in Southern California, much needed for us. So we'll keep our positive outlook for 2023. Joe, Alex, and I thank everybody for being on the call today. Our market outlook will be distributed. Joe, would you like to comment on that?
Yep, we'll be distributing it out tomorrow. So expect an email, and it'll be posted on different various websites. And let us know if you'd like a hard copy as well.
Very good. And if anybody has any follow-up questions, feel free to reach out to your advisor, or feel free to reach out to us directly, and we will be happy to speak to you or set up a time to follow up with you. Thank you very much, and happy February to everybody.
Thank you.
Thank you.